Welcome to J Academy, Chapter 10. Chapter 10 is all about money. First, what are the uses of money? We have three uses. Money is used as a medium of exchange, meaning it helps us in times to obtain other goods and services, meaning I can trade my labor for something of a different value or of a different origin, such as maybe an iPhone. Money is also used as a unit of account, meaning it helps us in comparing the price of goods and services. It helps us to determine the value between two related or unrelated goods. Money is used as a store of value. If we store our money away, it helps to maintain what we've worked for. It helps to maintain all of our hard efforts. There's 6 characteristics of money. We have our first one is durability. It has to be able to withstand wear and tear. They used to use gold as a form because it was very durable and would last through many decades. Portability. One issue with gold is sometimes it could be difficult or be heavy to be moved, and so we've used other forms of currency throughout history. Currently, we use paper currency, making it very easy to be moved. Divisibility. It has to be easily divided in order to come to the proper value of a good. So if you look at our currency, it moves along typically in 5s in order to help us obtain. Uniformity. They are all the same. We can't have differing currencies going through. Back in the day, they used to have states with different currencies. This led to many issues as people were unclear about which value is which. Now we have a single Federal Reserve note nominated by the federal government. Limited supply. Money has to have a limited supply in order to have any worth or any value. If we were to use something common outside, say like dirt, or if we were to use leaves, in order to obtain more of the value, we could just go outside and grab more. People would not accept it as a form of payment for any debt. And lastly, acceptability. We all have to agree. We all have to be on the same page and agree that a dollar is a dollar. Now we have 3 different types of money and values that we've discussed in class. First is commodity money, meaning naturally occurring substances. So things that we've often used throughout history, or even today we could still use, would be precious metals, precious stones, such as diamonds. Representative money. The most famous case was greenbacks. These were issued through the Civil War, and it was just money that was not backed by gold or silver, and it was money that was supposed to represent a federal bond in order to pay debts. Often, we could see it, representative money, in potential forms of, like, say, gift cards. This equals this. Fiat money. This is money that the government says is money. It is not backed by anything. It is not backed by gold. It is not backed by silver. It is not backed by any precious metals. It is backed because the government says it is acceptable. As we noted in class, on the dollar bill, it says this note is good for all public and private debts. Now, one of the systems that we talked about that the United States was on until 1971 was the gold standard. Our gold standard led to many different issues. However, The gold standard was basically a specific set of gold was worth a specific set in paper currency. And so say the government or the markets had gold pegged at $500 an ounce. If we were to issue $1 bills, each $1 would equal approximately 0.002 ounces of gold. This being said, we could only release so many dollar bills because we had to have enough gold to make sure that each dollar bill was backed. Now, this created a very limited supply in money. Money was more valuable, but at the same time, it wasn't as accessible, and it hindered our economy and led to many different recessions. In order to continue to improve our economy, in order to continue to stabilize our banking system, we moved away from the gold standard system and we moved into a central banking. And central banking, as we have seen, has had a long history in this country. It has varied. We've had 3 different charters. First one in 1791, next one in 1816, and our most recent one that we all know today is 1913. This created a central bank of the United States in order to prevent fraud banks from popping up, things such as like wildcat banks, like we discussed at class, where a bank is here one day and people deposit all their money, and the next day the bank decides to up and leave and take everyone's savings. Currencies were floating all over, no one had a consistency, and there was an acceptability. And so the Federal Reserve Act of 1913 established a central bank. Now our central bank currently has 12 different branches. The goal of the Federal Reserve Bank is to, 1, issue standard currency, and they do so giving short-term low-interest loans and printing off as well different notes, as well as being the lender of last resort. Now, in case a bank needs more money, the Federal Reserve is there in order to help the bank get through. The Federal Reserve is also in control of the overall money supply. Now, when we look at banking on a smaller scale, we operate with a fractional banking system, meaning if Mr. Jorman deposits $100 into the bank account, the bank only has to keep a fraction of it. Let's just say 20%. This is called the reserve requirement. The bank is then free to lend out the remaining amount of money, the next $80. When the bank lends it out to, say, Joe for going in order to purchase some gun, Joe takes that $80, goes and spends it, and it ends up getting deposited in another bank. The next bank has to keep that 20% and is free to lend out the 60. And so forth and so forth. The bank lends it out. The bank has to hold on to part of it and gets to lend out part of it. And this process continues all the way through using the money multiplier effect. They have to keep a small portion of it and they get to lend out the rest. Now at this rate, once it's all said and done with, overall money supply has dramatically increased. When it really started off with just $100, it has now increased dramatically over the course. The bank lends out the money each time and profits by charging a specific interest rate to loan the money. The bank lures you in by giving you a specific set of interest, say 1%, in order to store your money there. The bank in turn charges much higher rates, say somewhere around 6%. And the difference is what the bank profits on from the transaction here. This is called the fractional banking system. Now this has run us into issues in the past, as the bank then has the incentive, if they want to make money, to lend out a lot of money, to lend out more loans than they maybe should. In 2007 to 2009, we had a Great Recession. This was due to risky loans and quote-unquote subprime mortgages, meaning the banks were seeking profit in order to continue to grow their banks as well as their income, and they would lend out risky loans to people who potentially they might not ordinarily lend it to. When people would default on their loans, the banks were in turn stuck with a lot of liabilities. They'd become less likely to lend out. People would be less likely to go, or more difficult to go and get money. And this in turn ended up seizing up the money in circulation. As banks became more scared to loan, people were defaulting, banks were losing a lot of money, banks were going under, and there was a large amount of bank failures. In 2010, we hit our peak of bank failures at 157. Now this presented a problem for the overall money supply. In the last part of this chapter, we talk about the difference in money supplies. We have M1 and M2. M1 is things such as cash and checking deposits. This calculation is very liquid, meaning that the money is easily able to be spent and turned into other transactions. Now, in M2, we consider things such as CDs, mutual funds, other time deposits. This is money that is less liquid. This, M2, makes up a much larger share of the overall money supply, where M1 is a very small share. You could credit this to things such as we talked before of the fractional banking system, where banks continue to lend out money, liquid assets such as cash and other checkable deposits, and in turn lend it out, and the money supply continues to multiply as people have access to other people's savings. Now this will conclude Chapter 10.